Good afternoon, everybody. This is Andy O'Fee, the Yankee Closer. Today is Wednesday, January the 17th, and I hope everyone has been enjoying, at least trying to enjoy, some of their time off with their children during snow days. But the market has been moving along, and if you haven't been paying attention to CNBC or Bloomberg, you've seen some incredible volatility in the stock market. We saw stocks yesterday break through 26,000, the news that the government potentially could have a shutdown. We saw a 350-point reversal. And today, now we're starting to see stocks back up again over 250 points, over 26,000. So one of the interesting things I want to point out to you today, just keep this in mind, and Peter Bookvar made a very good comment today in a lot of the readings that I get through, is there is a bullish bearish sentiment tracker that looks at the number of people who are either bullish on the market or bearish on the market. And right now we're at a incredibly high number as far as the bullish number goes. It's the highest number we've seen since 1986. And what that is a concern about is that you've got more people in the market being bulls and less being out of the market, the bears. Where is the new money going to go if they come in to keep the stock market where it has been going? It's very, very interesting to think about. So I started my career back in 1986, 87 at Merrill Lynch, and I'm sure a lot of you will remember that in October of 1987, we had a huge correction in the stock market. Back at that time also, the government just went through a series of huge tax cuts too. So the scenario looks very, very similar to what we had back in the late 1980s as far as any type of correction on the stock market. So today we're going to ride the wave with stocks and just see what happens. But again, it's eerily similar to what happened back in 1986 with the tax cuts. We saw the same bullish bearish sentiment at all, the huge discrepancy. And now we're looking at a potential correction in the market, which I've been watching. We're not getting it today yet, but it's something very, very, very important to keep an eye out as far as what's going on in our market. Wednesday, we also always get the number of mortgage applications from the Mortgage Bankers Association, and those numbers were higher. This number year over year for purchases is up 7%, which is fantastic. Refinances are actually up a little bit too, even though we did see interest rates up anywhere between a 0.1 to a 0.125 year over year from this point of last year. So very, very good news. We also had the National Association of Home Builders Index come out. That number came in a little bit lower after last month's 18-year high number. It came in at 72. But all of these indications are pointing towards a good, strong housing market. But this is the most important part of this video that I want you to share with your customers, because these are things that they are going to need to know. There's a lot of talk in the news now about wage-pressured inflation, as well as why are rates slowly creeping up. Well, nobody seems to be able to answer that question, and the number one reason why wage pressures, we're not seeing any inflation on that side, is because of technology. Technology is going to be the driving force in keeping costs down, which is good for the bond market. When we see inflationary pressures, we start to see rates inch higher. But on the flip side, the other scenario now that we're talking about are why are rates inching higher? Well, no, it has nothing to do with the Fed coming into the market and potentially raising short-term rates. We've seen what they did last year. The market just barely nudged on what they did. It's the fact that their balance sheet is going to be reduced throughout the year. 4 billion, 8 billion, 12 billion, all the way out to 20 billion towards the end of the year in these incremental moves. So less purchases on the market are going to add more supply and mortgages as well as treasuries, and that is going to be the driving force to interest rates. So my point in this last part of the video is to get your clients involved right now. If they're locking a rate within the next 30 to 60 days, they're going to get a lower rate today than they will in 6 to 8 months. Now, like I said, I'm not guaranteeing that rates are going to spike from 4 to 5 over a short period of time. They're going to wash back and forth here and there, but I'm telling you now that between now and the end of the second quarter, rates will be higher with the fact that the government is purchasing less in the secondary market, putting more supply on the market, pushing yields higher, and in turn pushing our rates higher. This is Andy O'Fee, the Yankee Closer. If you have any questions or would like to discuss any of this, I'd love to hear it from you. Please, if your clients have questions about it, I'd love to get in front of them too and discuss these options. Whether or not they're using me as their lender, I think this is great information for you to share with them. Hope everyone has a great Wednesday. And hey, the kids are hopefully back in school tomorrow. Thanks a lot. Talk to you soon.